Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. In this video we will be evaluating the portfolio performance, discussing the portfolio composition, and revealing my new additions to the portfolio. So be sure to watch through the end of the video. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, cue the logo. Let's start off with the market's performance. For the month of August, the S&P 500 returned 3.7%. The market again hit all-time highs in the face of declining inflation, in anticipation of interest rate cuts expected to come in September. Both highly levered and strong dividend companies saw a boost in their share price. In the last week of August, the Dow achieved a better gain than both the S&P 500 and the Nasdaq 100. Here we can see that the S&P 500 had an overall good month. Big tech companies like Nvidia and Apple gained, while Microsoft remained neutral and Alphabet and Amazon fell. Over in our corner of the market, non-alcoholic beverage, farm products, confectionery, consumer packaged foods, and restaurant companies gained, while alcoholic beverage companies fell. Clearly the market has favorite areas of investment for food, beverage, and restaurant stocks. August also had a few big earnings reports. Celsius beat on earnings per share, achieving 28 cents versus expectations of 23 cents. This was a 22% surprise to the upside. Cava beat on earnings per share, achieving 17 cents versus expectations of 13 cents, a 31% surprise to the upside. On the losing side, Sweetgreen missed on earnings per share, achieving minus 13 cents versus expectations of minus 11 cents, a minus 18% surprise to the downside. Okay, let's move on to the portfolio performance. I deposited $100 into the account on the 1st of August, 2024, and at the end of the month the portfolio balance was $205.39. This means the portfolio was up $4.03 for the month, representing a 2% return for August. Given the S&P 500's 3.7% return, we lost 1.7% of alpha by not being invested in the S&P 500. Ouch. Since inception, the portfolio has had a 2.6% return on a money-weighted basis, while the return on a time-weighted basis was 2.7%. Given the S&P 500's 3.2% return, we lost just 0.6% of alpha by not being invested in the S&P 500 since inception. I am happy with these returns so far. I never really expected to beat the S&P 500, and I'm starting to see how certain portfolio strategies could move us closer to competing with it. Now let's look at the portfolio moves for the month. First, I bought some more Celsius on the 1st of August, then added to my Kura Sushi position on the 5th of August. On the 8th of August, I took advantage of the post-earnings dip and started a position in Dutch Brothers. We will discuss this a bit later in the video. Next, I took advantage of the sad news that Brian Niccol was leaving Chipotle and added to my position. Long story short, I think Chipotle will do just fine without him. On the 15th of August I averaged down in Celsius and bought some Pepsi. On the 29th of August I bought more Celsius and decided to take the plunge and open a position in Texas Roadhouse on the 30th of August. Okay, let's take a look at the portfolio positions. Let's look closer at each holding. Chipotle is now my largest holding, with 1.1 shares at a cost basis of $49.67. This position is up 12.9%. Chipotle makes up 30.1% of the portfolio. While Brian Niccol leaving the company for Starbucks was a shock, the rapid sell-off made no sense to me. Since recovering from the food sickness issue and implementing drive-through lanes at many Chipotle restaurants, the company's growth was pretty much on autopilot. Though it is possible a new CEO could mess up the company, I think there are enough strong processes and policies in place to keep the ship moving in the right direction. Clearly, I am still very bullish on the company. Celsius is now my number 2 holding, with 1.05 shares at a cost basis of $47.61. This position is down 20.1%. Celsius makes up 19.4% of the portfolio. It sucks that this position is down so much, but the fundamentals have not changed. They still have great growth margins, massive revenue and free cash flow growth, and a strong and growing return on invested capital. I have been and plan to continue averaging down. Pepsi is my third largest holding, with 0.15 shares at a cost basis of $164.11. This position is up 5.3%. Pepsi makes up 12.7% of the portfolio. Nothing new to say about Pepsi, it remains a key anchor for my portfolio, providing stability and a nice dividend. Next, Texas Roadhouse, with 0.12 shares at a cost basis of $168.02. This position is up 0.4%. Texas Roadhouse makes up 9.5% of the portfolio. Though the valuation might seem a bit high here, I really wanted to start a position sooner than later. This is a great company that continues to grow by offering high value to customers. I will plan to average down as needed in this company. Here we have Starbucks, with 0.13 shares at a cost basis of $75.07. This position is up 26%. Starbucks makes up 6.2% of the portfolio. I would have liked to add more to the position, but the Brian Niccol announcement pushed the share price out of my buy zone. I actually think the company has some tough times ahead. Niccol is a great CEO, but Starbucks faces different challenges than Chipotle had. Still, Starbucks is a great blue chip restaurant company and will be around for a long time to come. Now, we have the sushi restaurant Kura Sushi, with 0.19 shares at a cost basis of $52.09. This position is up 26.7% and is my best performing position. Kura Sushi makes up 6.1% of the portfolio. Similar to Texas Roadhouse, I think Kura Sushi offers a unique value proposition for customers. Though they are not yet profitable, I do think that they will be able to manage the challenging economic times ahead and emerge a growth story in a few quarters. Next, my only food holding, Hershey, with 0.05 shares at a cost basis of $182.22. This position is up 5.9%. Hershey makes up 5.1% of the portfolio. Hershey is clearly not a growth stock, but I believe they have a great chance of generating revenue growth that outpaces inflation. Given the company's high return on invested capital, I am pretty confident that they can continue to reinvest and grow earnings per share for the long run. Now we have the penultimate and new addition, Dutch Brothers, with 0.18 shares at a cost basis of $27.98. This position is up 10.8%. Dutch Bros makes up 2.7% of the portfolio. This was a buy of a fast-growing company that had a big pullback after earnings. The company is growing efficiently and has just become profitable. The share price is very volatile, so I will look to add to this position strategically. Last, I have about 8.2% in cash that we will carry over to next month and also earn interest on. As far as the metrics for the portfolio, weighted average gross margin, revenue per share growth, free cash flow per share growth, return on invested capital, net debt to EBITDA, and earnings yield on cost are all worse now when compared to last month. Only the cash conversion cycle has improved, falling down to 23 days. I think this change in metrics comes primarily from the large Chipotle and Texas Roadhouse buys. Still, I am happy with a portfolio that has 40% gross margins, 33% revenue per share CAGR, and a 21% return on invested capital. Looking forward, revenues are declining across the entire food space. This is highlighted very well in my recent video on market share trends. So clearly the entire food industry was growing until this year but has been decelerating for a while. The market grew by 16% from 2020 to 2021, 10% from 2021 to 2022, 4% from 2022 to 2023, and declined by 3% since last year. Essentially, food spend has begun to contract. This is not good and points to more trouble for the wider food industry. Unfortunately, I think the state of the consumer will worsen over the next few months. My goal is to find efficient market share gainers despite overall industry trends. All in all, I am very happy with the companies in my portfolio. Now the challenge will be add strategically to these positions while keeping valuation in mind. Many thanks for watching. What do you think about the portfolio? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.